Welcome to this explainer. I am super excited you're here today. We are going to put on our expert investment analyst hats and run a massive player in the consumer health space through what I like to call the valuation gauntlet. We're looking at Kenvue, trading under the ticker KVU. And to do this right, we're going to lean on the legendary investing frameworks of Warren Buffett, Peter Lynch, and Benjamin Graham, plus some rigorous quantitative modeling, just to see if this stock is truly worth your hard-earned money.
Now, even if the name Kenvue doesn't ring a bell right off the bat, I guarantee you know their products. They're actually the world's largest pure-play consumer health company, fresh off a spinoff from Johnson & Johnson. We are talking about literal household staples here. Tylenol, Neutrogena, Listerine, Band-Aid. These are iconic, science-backed brands that folks rely on every single day. But, as we often see in investing, a fantastic brand doesn't automatically equal a fantastic stock at its current price. We really have to do the math.
So here's our roadmap for today. We'll kick things off with a quick company snapshot, then look through the Buffett and Lynch lenses, move on to the Benjamin Graham lens, tackle a DCF valuation, look at some alternative models, and finally wrap it all up with our synthesis. Let's dive in.
All right, Section 1, Company Snapshot.
The juxtaposition of these vital stats is honestly kind of fascinating. We're looking at a share price of $19.79, giving Kenvue a market cap of roughly $38 billion. They also recently bumped up their quarterly dividend to 21 cents, which brings the annualized dividend yield to a very sweet 4.2%. But take a look at that trailing PE ratio, 23.56. So what does this actually mean for your money? Well, basically, for a defensive consumer staple stock, investors are paying a pretty hefty premium to get their hands on that yield. But wait, before we crunch any more numbers, we absolutely have to address the elephant in the room here. Kenvue is currently navigating a pending acquisition by Kimberly-Clark, which is expected to close in the second half of 2026. This is huge because it fundamentally caps the stock's upside and completely alters our long-term valuation thesis. I mean, Kenvue won't even be an independent entity for much longer. Throw in a $250 million restructuring initiative for 2026, plus the messy complexities of disentangling from J&J, and yeah, we have a highly complex valuation scenario on our hands.
Moving right along to Section 2, the Buffett and Lynch lenses.
These two lenses work very differently, which is why I love using them together. Buffett, as you probably know, looks for a deep economic moat, consistent owner earnings, and a high return on equity. He just wants wonderful companies at fair prices. Peter Lynch, on the other hand, wants to categorize the company first. Is it a slow grower, a stalwart, maybe a fast grower? He looks closely at the PEG ratio, that's price to earnings divided by growth. And interestingly enough, he actually prefers low institutional ownership. He wants to find those hidden gems before Wall Street catches on.
So, it begs the question, can Kenvue, which is essentially a slow-growing spin-off currently navigating a buyout, actually survive the strict criteria of these two investing legends?
The data here brilliantly illustrates the divide. For Buffett, Kenvue actually looks pretty darn good. It's got a massive economic moat with those legacy brands we talked about. It boasts a solid return on equity of 15.18%, and it generated a very healthy $1.7 billion in free cash flow. So it passes the Buffett quality test. But for Lynch, man, it's a tough sell. Kenvue is a classic slow grower, or stalwart, putting up organic growth of just 0.7% recently. The PEG ratio of 1.43 isn't exactly a screaming bargain, and a staggering 97.6% of the stock is already owned by institutions. Wall Street knows all about Kenvue. Lynch would almost certainly pass. So for your own portfolio, you kind of have to decide, are you buying for a safe moat, or are you buying for growth? Because Kenvue is definitely not offering both.
Let's pivot to Section 3, the Benjamin Graham lens.
If we run Kenvue through Graham's defensive investor checklist, the dashboard basically lights up red. Graham demands a highly conservative balance sheet, ideally a current ratio of 2.0. Kenvue sits at 0.98, meaning its current liabilities are actually slightly edging out its current assets. Graham wants a moderate PE below 15, Kenvue is up at 23.56. He wants a price-to-book ratio under 1.5, and Kenvue is trading at a PB of 3.58. For a defensive Graham investor, these multiples are simply way too rich. Plus, the balance sheet carries a bit too much debt, specifically a debt-to-free cash flow ratio of 4.75 that it inherited from the J&J spinoff. But hey, let's calculate Graham's famous intrinsic value formula anyway, just to find a target price. The formula is the square root of 22.5, multiplied by earnings per share, multiplied by book value per share. We know the adjusted EPS is $1.08. And to find that book value per share, we just take our current price of $19.79 and divide it by that price-to-book ratio of 3.58.
That assumption gives us a book value per share of exactly $5.53.
Okay, so we plug those numbers in, the square root of 22.5 times 1.08 times 5.53. And what do we get? Roughly $11.59. So at the current trading price of nearly $20 a share, there is absolutely zero margin of safety here for a Graham investor. To meet his criteria, the stock would need a pretty massive haircut. Next up, Section 4, Discounted Cash Flow, or DCF valuation. Here is the basic architecture of the math we're doing. First, we project future free cash flows, starting from that strong $1.7 billion base. Second, we calculate a terminal value using a perpetual growth method, assuming the company grows at a stable rate forever. And finally, we discount all those future numbers back to today's dollars using the weighted average cost of capital, or WACC. That just accounts for the risk and the time value of money. Now, normally, this is the part where I'd show you a beautiful sensitivity matrix forecasting out 10 years with a WACC between 8 and 10% and terminal growth of 1 to 2%. But here's the reality check. Modeling moderate growth into years 5 through 10 is mostly just a theoretical exercise for Kenvue right now. Because of that Kimberly-Clark acquisition closing in 2026, Kenvue's cash flows are going to be absorbed. A standard DCF implies an independent future that Kenvue simply won't have. So for us as investors, it means we can't really rely on 10-year cash projections to justify buying the stock today. While the underlying cash generation is fantastic, a standard 10-year DCF is structurally limited here. All right, Section 5, Alternative Valuation Models. Let's test out the Dividend Discount Model, or DDM. Kenvue's dividend is highly reliable. They have an 83-cent projected annual dividend, which is comfortably covered by a 68% payout ratio. If we assume a standard 8% cost of equity and a super conservative 2% long-term dividend growth rate, the math is straightforward. It's the dividend, divided by the cost of equity minus the growth rate. That spits out a fair value of $13.83. So even when we factor in that great yield, the model is telling us the stock is currently overvalued.
If we look at comparable company multiples, it's a bit of a mixed bag. The trailing PE of 23.56 is definitely high. The forward PE, which is based on projected earnings, drops to a slightly more reasonable 16.20. However, the enterprise value to EBITDA-TR ratio, which is great because it factors in the company's debt, is sitting at 14.35. In the consumer staples sector, an EV to EBITDA over 14 generally indicates a stock that is fully priced. It leaves very little room for error.
Finally, Section 6, Synthesis and Final Recommendation. Let's bring it all together. Look at the consensus across our models here. The current market price is 19.79. Graham's intrinsic value came in at 11.59. The dividend discount model gave us 13.83. And our DCF is inherently limited by the looming acquisition. Literally every purely quantitative metric we applied suggests that at nearly $20, you are paying a premium. Now, to be fair, you are paying that premium for some truly exceptional strengths. A highly secure 4.2% dividend yield, and a brand moat that Warren Buffett would absolutely love. I mean, Tylenol and Band-Aids aren't going anywhere. But as an investor, you have to weigh that against the risks. You're taking on a balance sheet carrying a high debt-to-free cash flow ratio of 4.75, and organic sales growth that is virtually stagnant at just 0.7%. So what is our final verdict based on all this data? It's a solid hold. For current shareholders, hey, the dividend is safe and attractive. But for new capital, the upside is severely capped by the Kimberly-Clark cash and stock deal. There just isn't enough organic growth to overcome those high valuation multiples. If you are a strict value investor following Graham or Lynch, your trigger price to buy into this moat would be significantly lower, down in that $11 to $13 range. And honestly, that's a dip that may never even happen before the acquisition closes. I'll leave you with this provocative thought to consider for your own portfolio. Kenvue's brands are undoubtedly legendary, but as we saw in the math today, brand power alone does not create a margin of safety. Does a spinoff's legacy brand moat ever truly justify a premium stock valuation if the organic growth just isn't there to back it up? Something to chew on. Thank you so much for walking through this valuation gauntlet with me on this explainer. Until next time, keep doing the maths.